Welcome to the deep dive. Today we're diving into a concept that might just fundamentally shift how you think about the future of technology. See, for the first time in the digital age, the AI revolution isn't primarily constrained by, say, capital or talent.
Right.
Instead, it's hitting a very real physical wall, the sheer availability of energy and, well, the infrastructure to deliver it.
Yeah.
Our sources are calling this the great constraint.
It's a really potent idea.
So we're exploring excerpts from this truly insightful report. It's titled The Great Constraint, AI, Energy, and Digital Economies, published just this year, 2025. And it paints a vivid and, frankly, a little startling picture of this new paradigm.
Yeah, it really does. It's striking to see this core tension laid out so clearly. You've got this truly exponential demand for computational power.
Just exploding upward.
Exactly, and it's colliding head-on with the linear, much slower expansion of our global energy systems. The numbers from the report are stark. I mean, really stark. We're talking about global data center energy demand basically doubling. Yeah, doubling to 100 gigawatts by 2029. And here's a real eye-opener. By the end of this year, 2025, AI operations alone, they're projected to surpass Bitcoin mining's power consumption.
Wow. How much is that?
Hitting an estimated 23 gigawatts. And look, this isn't just some abstract forecast, right?
No.
It's already creating a significant headwind for tech stocks. You can see it. While at the same time, it's unlocking these massive, unprecedented opportunities for energy and infrastructure players.
Okay, so what does this all mean for you listening in? Whether you're investing in tech or maybe just, watching its rapid evolution.
Yep.
Well, for tech leaders, securing power isn't just an operational detail anymore, right?
Not at all. It's become a new strategic imperative. Absolutely critical.
We're witnessing this almost frantic drive towards innovative, often off-grid solutions.
Yeah, everything.
Everything from small modular reactors, SMRs. These are basically smaller, factory-built nuclear reactors.
Right, designed for specific sites.
To dedicated on-site renewable energy projects. So think of this deep dive as your shortcut, your way to understand who wins in this newly energy-gated economy, and maybe more importantly, why.
Okay, let's unpack this. Let's start by looking at the sheer scale of the demand side. We're calling it the unstoppable force, the AI infrastructure supercycle of 2025. And this isn't just like an extension of existing cloud computing trends we've seen for years.
No, it's different. It's a fundamental step change in physical footprint and critically power density.
Yeah.
It's literally creating a new asset class, the hyperscale data center.
Hyperscale.
That's right. And the global data center construction market is it's absolutely exploding.
What kind of numbers are we talking?
Well, it's projected to more than double from over $90 billion in 2024 to well over $200 billion by 2030.
Wow.
And AI is driving over half of that growth this year alone. This whole surge is pushing us towards what they're calling gigawatt-scale data centers.
Gigawatts.
Yeah. And the fundamental shift here, the really interesting part, is in-site selection. Historically, it was all about cheap land or maybe fiber connectivity.
Right, location, location, location.
Yeah.
But for data.
Exactly. But now, the absolute top priority, the thing that eclipses even land acquisition, it's a pre-existing high-capacity connection to the power grid.
Why? Just because it takes too long to build new lines.
Precisely. Building new high-voltage transmission lines can take 4 years, maybe more. Permitting, construction, it's a huge bottleneck. So securing that power access, often through a multi-megawatt power purchase agreement, PPA, that's the true prize now.
Okay. And this has sparked what feels like a literal power grab phenomena, right? We're seeing distinct regional hotspots emerging globally.
Definitely.
Take the United States, still the dominant market, sure. Northern Virginia, for example, is set to add a staggering 9 gigawatts by 2030.
Which is huge.
Huge. But power constraints there are already so tight that investment is being pushed out to new frontiers like Texas, Atlanta, Arizona.
Yeah, they're looking for available capacity.
And in Europe, we're seeing de facto moratoriums in traditional data center markets. Frankfurt, London, Amsterdam, Paris, Dublin, the FLAPD group.
Right, the main hubs are hitting limits.
Which is forcing this scramble for new sites. Places like Spain, Norway, Italy, Portugal are suddenly looking very attractive.
And they saw record take-up last year, 2025, 855 megawatts, up 22% year on year.
Meanwhile, China's market, just staggering growth, driven by state support, national digital strategies.
Yeah.
They're targeting 800,000 racks by the end of this year.
An enormous build-out.
And even the GCC, the Gulf Cooperation Council countries, they're emerging as a strategic hub, obviously leveraging their energy resources.
Yeah.
Saudi Arabia is planning to add 500 megawatts by year end. It's a truly global shift.
Yeah, absolutely global. And at the heart of this, this colossal infrastructure build-out is what we're calling the GPU engine room.
The chips themselves.
Exactly. NVIDIA, the company behind most of these powerful AI chips, reported truly staggering results recently. Q2 of fiscal year 2025. Their data center segment revenue just soared. But what's really striking here is the sheer concentration of demand.
Who's buying all these chips?
Well, companies like Microsoft, Meta, Alphabet, Amazon, they account for over 40% of NVIDIA's total revenue.
40%. Just 4 companies.
Yeah. It signals these multi-billion-dollar commitments by the absolute tech titans. Think about Meta.
Yeah.
They're planning to spend up to $65 billion in capital expenditures in 2025.
$65 billion.
Primarily for AI and data centers. So while the GPU as a service market, GPUs, is growing and kind of democratizing access.
Letting smaller players use the power.
Right. But it fundamentally concentrates the actual physical hardware and therefore the massive power demand within these huge hyperscale cloud providers.
Okay, here's where it gets really interesting, I think. The exponential energy appetite of the large language models themselves. We're seeing this unprecedented surge in power density within the data centers. Standard server racks historically maybe consumed 5-10 kilowatts.
Yeah, that was typical.
For AI workloads, the average power density is anticipated to leap to 50 kilowatts by 2027. And top-tier deployments, they're already hitting over 100 kilowatts.
What's a huge jump?
And the GPUs themselves, the chips, they've gone from, 400 watts in 2022?
To 700 watts in 2023, and next-gen chips projected to hit 1,200 watts, maybe 2024, 2025.
1,200 watts for a single chip.
Yeah. This isn't Moore's law anymore, right? Where performance increases while power stays relatively constant.
Yeah.
This is Huang's law, as some are calling it, Jensen Huang, NVIDIA's CEO. It's exponentially more performance, yes, but for exponentially more power.
And the consequence of all that power, all that immense heat generation.
A wholesale, unavoidable shift to liquid cooling.
So fans aren't enough anymore.
Not even close. Liquid cooling is becoming the standard, pretty much, for new AI data center construction. It has to be.
This raises a critical question then. What's the actual energy cost of using these AI applications at scale?
It's a great question, and the report breaks it down. A single query on something like GPT-4o, for instance, consumes about 0.3 watt-hours of electricity.
Okay, 0.3 watt. How does that compare?
Well, it's roughly 10 times more than a traditional Google search.
10 times, okay.
But the real intensity, it shows up in more complex tasks. Processing a long document, say 10,000 tokens, that can consume 2.5 watt-hours.
Okay.
Analyzing a 200-page report, maybe 100,000 tokens, that can use nearly 40 watt-hours.
40, that's what, over 130 times the energy of just a simple chat query?
Exactly. And this illustrates a classic economic phenomenon. It's called the Jevons paradox.
Jevons paradox, remind me.
It sounds counterintuitive, but basically, the more efficient we make something, in this case AI, the more we find new ways to use it, because the applications become cheaper and more widespread.
Ah, so efficiency doesn't lead to less consumption overall.
It often leads to more consumption. The AI industry, rather than becoming truly energy efficient in an absolute sense, is actually on a path to greater consumption enabled by its increasing efficiency.
That's fascinating.
And the aggregate impact is truly staggering. AI operations alone are projected to consume 90 terawatt-hours annually by 2026.
90 terawatt hours.
That's a tenfold increase from 2022 levels.
Whenfold in just 4 years.
In just 4 years. And global data center energy demand overall, set to double from 50 gigawatts in 2024 to 100 gigawatts by 2029.
Wow. Okay, so if that's the demand side, this unstoppable force, what happens when it crashes into the other half? The global energy system.
Yeah.
Which, frankly, isn't moving nearly as fast. Let's turn to what the report calls the immovable object.
Right. And if we connect this to the bigger picture, we're witnessing what can only be described as an anatomy of a polycrisis. It's not just one thing.
A polycrisis, okay.
The primary bottleneck, interestingly, isn't even about generating enough power anymore necessarily. It's the transmission grid itself, the wires.
Getting the power where it needs to go.
Exactly. Building new high-capacity power lines can take 4 years, maybe more. And getting approval for a new generation, like a solar farm or a nuclear plant, to even connect to the grid. That can stretch to 6 years in the US and, believe it or not, 13 years in parts of Europe.
13 years just to get connected.
Yeah, the interconnection queues are incredibly long, and this infrastructure lag is happening just as overall electricity demand is surging. Fastest pace in decades.
Driven by.
Everything. Electrification across industries, more air conditioning, increased cooling needs in a warming world, and of course, this explosive AI demand. NERC, the North American Electric Reliability Corporation, recently noted its 10-year forecast for summer peak demand grew by an astonishing 50% in just 1 year.
50%.
Overwhelmingly due to data centers. Meanwhile, the supply side is fragile. Reliable, dispatchable power plants are retiring faster than they're being replaced. And crucial tech like large-scale battery storage isn't keeping pace yet.
So what does this all mean for you, the listener, the investor, the tech enthusiast?
It signals the definitive end of an era. The era where tech growth was basically decoupled from physical resource constraints. It felt limitless.
But it's not.
It's not. It's adding a very real physical world risk premium to tech valuations now.
And we're seeing these pressures manifest as acute stress in specific regional hotspots around the globe, right?
Absolutely. Europe, for example, still recovering from its 2022 energy crisis. Industrial electricity prices there in 2024 were roughly 2.5 times higher than in the U.S.
2.5 times.
And grid congestion, fragmented regulations, they're actively hindering power flow, even though they're building a lot of solar.
And India?
India's facing a perfect storm, a 9–10% surge in peak demand due to heat waves, crashing into a grid with chronic inefficiencies like up to 25% transmission and distribution losses.
A quarter of the power just lost.
Yeah. Plus, they're dependent on depleting domestic coal, vulnerable to import price shocks.
What about the U.S.?
In the U.S. Southwest, NERC has issued these stark warnings, elevated to high risk of controlled blackouts starting as early as 2025.
Controlled blackouts, you mean rolling blackouts?
Essentially, yes.
Yeah.
In major regions like SPP and ERT, that's Texas, demand from data centers, oil and gas electrification, manufacturing, it's just dramatically outpacing infrastructure development.
And even the Middle East, the GCC, they produce so much energy.
They do, but they're also experiencing a massive surge in their own domestic power demand. For smart cities, economic diversification projects, it's straining their systems too.
So these aren't isolated incidents.
Not at all. They're symptoms of a global energy system under immense, unprecedented strain.
This uneven distribution of energy security, it's creating a new kind of geopolitical competition, isn't it?
It really is.
Yeah.
Just like we had tax havens, we're now seeing the emergence of power havens.
Power havens.
Yeah. Regions with stable grids, streamlined permitting processes, and crucially, abundant, diverse power sources. Latin America, for instance, is explicitly positioning itself, leveraging its vast renewable resources to attract data center investment.
So future tech investment might flow based on energy policy.
This dynamic suggests that future capital flows in tech will be dictated as much by smart energy policy as by cutting-edge innovation policy. It's a huge shift.
And this tightening balance between supply and demand,
Yeah.
it must be hitting prices. You mentioned Europe, but what about elsewhere?
Oh, yeah. It's creating an inflationary shockwave, the rising cost of a watt.
How bad is it?
U.S. residential electricity prices surged over 26% between January 2021 and January 2025. That's outpacing overall inflation significantly.
Okay.
And here's a truly stunning example. PJM Interconnection, it's a major grid operator, covers a big chunk of the eastern U.S., lots of data centers there.
Right.
Wholesale capacity prices, basically the price to reserve future power supply for 2025-2026 delivery, they spiked an unprecedented 833%.
833%.
833%. That staggering increase directly squeezes data center profits. It makes reserving future power incredibly expensive.
So for data centers, where energy is a primary operational cost,
it's an existential threat to profitability. Projections suggest that even a sustained 10% annual increase in utility costs could make grid reliance economically unsustainable for some.
wow. So what's fascinating here then is how this economic reality,
Yeah.
it's forcing the big tech companies' hands, isn't it?
Absolutely. It's driving major tech companies to secure their own dedicated power sources. Why? To de-risk their core business.
Take control of supply and cost.
Exactly. And potentially reduce their operational expenditures by like 60–80% compared to facing volatile grid pricing. It's a massive incentive.
Okay, so let's talk about the collision course.
Yeah.
Where this digital ambition really starts hitting these physical limits.
Yeah.
This tension must be creating tangible conflicts, right?
Yeah.
Over resources regulation.
We're certainly seeing what the report calls the new power struggle emerging, specifically between AI and crypto.
AI versus crypto. How so?
Well, by the end of this year, 2025, AI's global energy demand projected at that 23 gigawatts we mentioned. It will more than double Bitcoin mining's relatively stable 10 gigawatts, so AI is already the bigger consumer and growing much faster. This marks the arrival of a second wave of energy-intensive computing, and it's fundamentally different from the first wave, which was Bitcoin.
How is it different?
Bitcoin mining was often nomadic, opportunistic. Miners would go wherever power was cheapest, often scavenging excess hydro or flared gas, kind of hit and run.
Okay.
AI, however, it's different. It's settled. It's civilization building in a sense. It requires these massive, permanent, high-reliability data centers located in or near major economic hubs, close to users, close to fiber.
So it's not mobile.
Right. And this creates a highly concentrated and inflexible load on regional power grids. It's a far more significant and systemic challenge for utility planners than the distributed, often transient load of crypto mining ever was.
And this strain inevitably is leading to the hand of the state. Regulation and rationing becoming the new normal.
It seems that way. Governments are actively intervening now, shifting from just encouraging efficiency to actually mandating grid citizenship.
Grid citizenship. What does that mean in practice?
Well, in the United States, look at Texas. Senate Bill 6, passed in 2025, grants the grid operator ERCOT unprecedented authority. They can actually curtail power to large industrial consumers, including data centers, during grid emergencies.
So they can just turn off a data center.
If grid stability requires it, yes. Imagine the operational impact. Your needs are now explicitly subordinated to the grid's health.
That's a huge. What about Europe?
In Europe, the updated Energy Efficiency Directive now requires data centers over 500 kilowatts to publicly report their power usage effectiveness, PUE, their water consumption, their carbon footprint. Transparency is the first step. And this has been accompanied by those de facto moratoriums on new data centers in places like Dublin. New measures are expected in 2026. Similar trends across Asia: Singapore, Japan, South Korea, Thailand. They're all adopting these dual approaches, promoting clean energy use by data centers, but also regulating their impact, often with clear procurement targets. This represents a fundamental shift, really. New policies are focusing squarely on the external impact these massive facilities have.
Right.
It's forcing data centers to become responsible grid participants,
Right.
which will inevitably drive up their capital expenditures. They'll need things like on-site energy storage, sophisticated demand response capabilities.
So they can reduce their load when the grid is stressed.
Exactly. These features, costly as they are basically becoming the price of admission to operate in this new energy-constrained world.
This brings us to the climate angle. The carbon calculus, a tale of two digital economies. Where does AI fit in the emissions picture?
Well, data centers already account for an estimated 4% of global electricity consumption and about 1% of total greenhouse gas emissions.
1% globally already.
Yeah. And training just one large language model like GPT-3 consumed around 12,287 megawatt hours. The carbon footprint of that depends heavily on the grid mix where it was trained, of course.
But as AI's power demand grows tenfold between 2022 and 2026, as you said,
its associated emissions are set to become a major policy focus globally. It's unavoidable.
But the cryptocurrency world offers a fascinating contrast here, doesn't it?
It really does. A divergent case study. Ethereum's 2022 merge to proof of stake, or POS, that reduced its energy consumption by over 99.95%.
99.95%.
Yeah. It slashed its carbon footprint from like 110 kilograms of CO2 per transaction down to just 0.01 kilograms, a massive drop.
So this raises a really important question for all of us then.
Yeah.
Can AI follow a similar path? Can it develop architectural or algorithmic innovations that truly decouple computational growth from energy consumption?
Or is it destined to be one of the world's largest new drivers of carbon emissions? That's the multi-trillion-dollar question, isn't it?
It really is. Okay, so this energy tech collision, as you might imagine, it's sending powerful tremors through financial markets. We're seeing significant sector rotations, asset repricing.
Oh, definitely. We're seeing this dynamic of tech volatility versus energy stability play out. It's a fascinating tale of two ETFs if you look at the sector funds.
That's so.
In Q1 of 2025, the energy sector, XLE, was the market standout performer, up nearly 10%, while the tech sector, XLK, was among the hardest hit.
Okay, so energy up, tech down.
Right. But then April 2025 saw this dramatic reversal. Tech XLK gained over 1.6%, while Energy XLE plummeted by nearly 14%.
Complete flip, so very volatile.
Extremely volatile. Year to date, as of the end of May 2025, both ETFs showed this bumpiness. Tech was down slightly, energy down a bit more. It really illustrates this symbiotic yet antagonistic relationship.
Symbiotic yet antagonistic. Explain that.
Well, AI's demand fuels energy sector growth, obviously, that's the symbiotic part, but the resulting higher energy prices, they directly tax tech's operational costs, compressing margins. That's the antagonism.
Oh, I see.
So what's becoming clearer for investors is maybe the most effective way to get AI exposure isn't just buying AI stocks. It might actually be owning energy and infrastructure companies.
The literal picks and shovels of electrons, as the report puts it.
Exactly, the enablers.
And this dynamic is also squeezing crypto miners, you mentioned, in a major way.
Oh, yes. It's getting tough for them. Electricity is our primary raw material, right?
Right.
So rising energy costs, combined with the increasing computational difficulty of mining Bitcoin, it has severely squeezed profitability.
How much?
The median cost to produce one Bitcoin surged from around $52,000 in Q4 2024 to over $70,000 in Q2 2025.
Wow, a huge jump in cost.
Almost entirely due to energy price inflation. We saw one major miner, TeraWulf, report its electricity costs nearly doubled to over 8 cents per kilowatt hour.
Ouch. So what does this all mean for the crypto space? Are miners just going out of business?
We're seeing a profound strategic evolution. Pure play Bitcoin miners, the ones just focused on mining, their stocks are falling significantly, down over 20% between May and June 2025 alone.
But
Miners who are strategically pivoting, using their facilities, and, crucially, their existing long-term low-cost power contracts.
Rate PPAs.
Exactly. Pivoting to host AI workloads, high-performance computing, HPC, they're outperforming. Companies like IRN, Core Scientific, Cipher Mining.
So the most valuable asset for a crypto miner now, it's not the mining rigs.
Increasingly, no. It's their power purchase agreement, their PPA.
Right.
They are effectively evolving from being pure computational players into sophisticated energy arbitrageurs.
Reselling their power access to the AI industry.
Pretty much. It's a fascinating pivot.
Okay, we connect this to the bigger picture of capital flows. Diverging capital flows, the report calls it. Is institutional money still going into digital assets?
It is, yeah. Institutional capital is still pouring in. The report cites data showing over 85% of institutional investors either have exposure or plan to allocate capital to digital assets.
Okay, so the interest is still there.
Definitely. However, how that capital is being deployed is changing. It's now being guided by this critical new due diligence filter: energy security.
So investors are asking different questions now.
Completely different questions. Key questions for investors are now: where does your power come from? What's the long-term cost and stability of that power? What is your strategy for mitigating grid risk and price volatility? The physical supply chain for electrons has become just as important as the digital supply chain for data.
This situation, it feels like it has strong echoes of past market cycles, doesn't it? The report mentions some historical parallels.
It really does. Think back to the Nifty 50 in the early 1970s.
Okay, the blue chip growth stocks back then.
Right. Seemed invincible, extreme valuations. Then they were shattered by the 1973 OPEC oil embargo.
An external resource shock.
Exactly. That triggered one of the steepest market declines in decades. The parallel to today's Magnificent Seven AI stocks potentially facing this looming electricity scarcity. It's quite striking.
Or the dot-com bust.
Or the dot-com bust of 2000, fueled by that new era narrative, easy capital. Fundamentally ignored fundamentals. It got pricked by rising interest rates. The AI boom is driven by a similarly transformative narrative, right? But it faces a constraint the dot-com era never did.
A hard physical limit.
A hard physical limit on the energy required to actually power its growth. The dot-com bust was ultimately a crisis of financial capital. The AI energy crisis, fundamentally, is one of physical capital. Energy.
So given all this, what's the path to resilience? It sounds like it requires a pretty fundamental rethinking of how we power digital infrastructure in the 21st century.
It absolutely does. And among the most promising solutions, one that's gaining serious traction, is what the report calls the nuclear option, specifically small modular reactors, or SMRs.
SMRs as the baseload for AI.
Exactly. Nuclear energy offers several key advantages for data centers. It's clean, carbon-free, provides 247 baseload power, crucial for AI, and it has incredibly high reliability, like 99.999% uptime.
Plus high energy density, small land footprint.
Right. Ideal for co-location right on data center campuses. It reduces reliance on those long-distance transmission lines we talked about.
And SMRs specifically, they're smaller, factory-built.
Yeah, it's designed to be factory built, assembled on site. The promise is reduced construction times, lower capital expenditure compared to giant traditional plants, and greater scalability. Build what you need.
What are the challenges, though? It can't be that easy.
Oh, there are challenges. High initial capex is still a factor, even if lower than traditional nukes. Long licensing processes, public acceptance hurdles. Widespread deployment probably isn't expected until the 2030s, realistically.
But big tech isn't waiting, right?
They are absolutely not waiting. Microsoft has an agreement, potentially, to help restart the 3 Mile Island nuclear plant. Amazon is purchasing 960 megawatts of power directly from the Susquehanna nuclear plant in Pennsylvania.
Buying nuclear power directly.
Yeah. This signals a profound strategic shift by big tech. They're moving to secure their own dedicated carbon-free baseload power, effectively bypassing the public grid entirely in some cases.
Okay, so beyond nuclear, what else? We're seeing the rise of on-site and alternative power more broadly.
Definitely. This trend is all about achieving energy independence, driven by the need for resilience and, importantly, cost predictability.
So renewables, solar and wind.
Solar and wind are becoming far more viable for data centers if they're paired with large-scale battery energy storage systems, BESS.
The batteries are key.
The batteries are absolutely key, along with sophisticated AI-powered energy management software. That combination allows them to create a more reliable 247 power profile, smoothing out the intermittency.
What about geothermal?
Geothermal energy is another really powerful option. It's renewable, it's firm meaning consistent, and it provides 247 baseload power. Analysis suggests it could economically meet up to 64% of projected data center demand growth by the early 2030s, but only in geographically favorable regions.
And hybrid systems, mixing sources.
Yeah, many developers are pursuing hybrid systems now, combining multiple sources, maybe solar plus batteries, plus natural gas fuel cells or generators for backup, whatever gives maximum reliability. These hybrid approaches often show lower overall levelized cost of energy, LCOE, and can have significantly reduced carbon emissions compared to just grid power.
So the primary economic benefit of all these on-site strategies, it's cost predictability.
That's a huge driver, cost predictability, insulating these massive operations from wild price volatility on the grid and avoiding those escalating transmission and distribution charges we talked about. It creates a significant competitive advantage.
But this shift towards private power generation, does it raise other issues?
It could. It could lead to this fascinating yet potentially problematic balkanization of the power grid.
Balkanization, meaning?
Imagine a future with two tiers. A hyper-reliable, privately funded, gold-plated grid serving only critical digital infrastructure and wealthy customers. While the public grid potentially struggles, maybe losing its largest industrial customers and their revenue.
Which could impact everyone else.
Exactly. It raises really important questions about energy equity and access for ordinary households and smaller businesses.
Okay, so for you, the listener, the investor, navigating this new energy-gated future, what's the playbook? What should you be looking for? It sounds like it goes beyond the obvious plays like just buying NVIDIA or broad energy ETFs.
Absolutely. You need to look for the second and third order beneficiaries, the companies that are directly solving these critical bottlenecks we've been discussing.
Such as?
Enabling infrastructure. Think about companies involved in grid modernization, updating the aging grid. Manufacturers of high-voltage equipment like transformers and switchgear.
Which you said have huge lead times now.
Exactly. Lead times exceeding 46 weeks in some cases.
Yeah.
That signals a massive demand bottleneck. Also, companies developing advanced liquid cooling technologies. That's a huge growth area.
What else?
The nuclear value chain. Not just the reactor developers, but the entire uranium supply chain. Look at the Global X Uranium ETF URA. It's been a top performer. Also, longer-term venture or growth equity plays in SMR and microreactor designs.
And energy arbitrage.
Yes, energy arbitrage and services. Those crypto miners successfully pivoting to AI hosting are interesting. Plus, new firms emerging that specialize in developing and financing these on-site power solutions for data centers. Even advisory firms helping navigate PPAs.
So for portfolio construction, the key is balance.
Balance is essential, given the volatility we discussed between tech and energy. It makes sense to hedge pure AI exposure with strategic investments in the energy, industrial, and utility sectors, the physical enablers.
What's truly revolutionary here, the report suggests, is this concept of energy as a feature. Can you explain that?
Yeah, it's a fascinating idea. In the past, compute power was the core product. Now, the ability to deliver that compute reliably, sustainably, and crucially at a predictable cost, that is becoming a premium feature itself.
So reliability becomes part of the sales pitch.
Exactly. Cloud providers and data center operators who successfully secure their own power, who manage their energy strategy well, they'll be able to offer a genuinely superior product. Their value proposition shifts. It's not just our AI is smarter, it's our AI will always be on, and your bill will never be a surprise.
Wow. So energy strategy becomes a core component of the product offering.
Not just an operational footnote anymore, it's front and center.
Okay. So our deep dive today leads us to, well, a pretty unequivocal conclusion, doesn't it? The era of assuming limitless, cheap energy to power digital expansion. It's over.
It's over. The great constraint isn't some temporary headwind. It seems to be the defining characteristic of this entire technological cycle. It's fundamentally altering corporate strategy, capital flows, government intervention, everything.
And the core insight for you to take away from this?
It's this. The long-term winners in the AI revolution won't be determined solely by who has the smartest algorithm. It will also be about the foresight, the resilience, and the sustainability of their energy strategies. That's become paramount.
So for investors, this new paradigm demands a new analytical framework, one that explicitly incorporates this physical world risk premium we talked about.
You have to factor it in.
And the most compelling opportunities, as we've discussed, might actually be in the often overlooked enabling infrastructure, the plumbing, the wiring,
The picks and shovels, yeah.
for policymakers.
The challenge is huge. They need to move beyond siloed thinking, develop holistic strategies that actually integrate digital policy with energy policy. Foster innovation, yes, but also streamline permitting for needed infrastructure and encourage that grid citizenship among the biggest energy consumers.
And for the tech industry itself.
It demands a profound shift in mindset. They can't just be passive consumers of energy anymore. They need to become active, responsible partners in building a resilient, sustainable, and intelligent energy grid for the future.
So, the great constraint. It's not just a challenge to be overcome. It's maybe the primary force that will shape the next decade of technological progress. As you go about your day, maybe consider what this means for the future of digital accessibility globally. What happens if only the wealthiest companies and the wealthiest nations can afford the massive energy required for advanced AI?
Yeah.
How might that reshape the digital divide? It's a critical question. Success in this new era will truly belong to those who understand that in the 21st century, all computational power ultimately flows from physical power.